Yeah, thanks everyone for coming along to our Introduction to Pairs Trading webinar. My name's Robert Bubalovski, and I'm the Managing Director or the Head Trader here at TradeView Investments. Okay, we're just basically a small proprietary trading firm in Melbourne, Australia, using algorithmic trading. All right, let's get into Introduction to Pairs Trading. Okay, so this is a little bit of a quick risk warning to explain that trading leverage products carries a significant risk and is not suitable for all investors. You need to ensure that you fully understand the products and the risks involved before entering into any trades, and you can lose substantially more than your initial deposit. And we recommend that you seek independent advice. The presentation is provided for information purposes only and should not be considered as a financial product advice. And we don't take into account your specific needs and objectives. TradeView Investments is a corporate authorised representative of international capital markets. That's their AFSL number, and that's our authorised rep number. All right, so today we're going to cover what is pairs trading, simplified pairs trading, strategies, calculation, system development. And I do want people to note that these trading strategies are actively managed and should not be used unless you fully understand them. Before I go into pairs trading, I think it's important to quickly note that we speak to quite a few traders and we interview a few traders as well. And everybody seems to know, or says they seem to know, what pairs trading is. But there are very little traders that we come across that actually pairs trade. And I think the main thing that we're getting out of the interviews is that they all want to make money straight away. Unfortunately, with pairs trading, that's not the way it works. So I just thought I'd present that because everybody wants to make money now. And I think that's something that you need to be aware of when you're trading something like this. Okay, look, pairs trading basically is becoming one of the most popular trading strategies. It's also known as stat arb, and it looks at eliminating market direction or influence. Now, stat arb has been used by the banks and some of the more prominent firms for a very long time. Basically, it eliminates, or it tries to eliminate, market direction. The strategy is strong on a quantitative approach and is mechanical in nature. So there's a lot of there are quite a fair bit of mathematical formulas involved to get it right. We will use a simplified version just to get people started if they've never really developed it. The general rule is that you buy an underperforming instrument and you sell an outperforming instrument. The reason for this is simply to take a net position and eliminate market influence or getting stopped out with extreme market volatility. Now, I think this has actually come in a pretty good time with the volatility, the way it's spiked in the markets. And, pairs trading strategy can actually help you avoid some of this. So effectively, if an overall market rises and the product you think will outperform should rise more than the product you think will underperform, leaving you in a profit. And same as if the market falls, the product you think will underperform should fall more than the product you think will outperform. Basically, you're trying to maximize one performer over the other. And what we're basically looking for is the spread between two instruments to widen and then take advantage when the spread closes again. Okay, simplified pairs trading. What we want to do is we want to identify instruments that historically move approximately the same number of points or percentage per week, per day, per month, or per year. Now, if you want to get really aggressive with pairs trading or stat arb, you could bring it down to a 1 minute or a 5 minute time frame. but we'll talk about more of a daily basis in the presentation, just to give you an idea, because we did a presentation last month, and I'm going to show you how that scenario played out. So pairs trading is typically used for stocks or indices and FX. I'd probably say with stocks it would be used across, and some guys that I know use it quite heavily on stocks, on your BHPs, your Rios, any of your dual listed stuff. So BHP ADRs in the US, and then you've also got the London session as well. So there's 3 sessions where you can trade some of these stocks. Indices, we'll cover those, and some FX products. We will look at the following correlated products, okay? So, and some of the daily moves for 2014 for these particular products are approximately this. The DAX and the FTSE. So the DAX is the German market, and the FTSE is the UK market. The DAX has moved approximately 113 points a day. The FTSE's moved about 57. Okay, that's just for 2014. The Dow and the S&P, the Dow's moved about 127 on a daily basis, and the SPX, or the S&P, it's actually moved approximately 15 points. Now you multiply that by 10 to give you 150. So therefore, that's just how you would trade the Dow and the S&P. Usually, it's a 10 times multiple. So you can see there that there's a bit of a discrepancy here, but in the Dow and the S&P, it's quite close. So there's a ratio with the DAX and the FTSE that will need to be calculated before you place the trades. Okay, so something like this. This is one of our ARB systems, and what you see here is you see the markets moving away from each other, and then touching, and then moving away, and then touching again, and then you see here they've moved away, then they've come back and touched here, and now they're back. There's a bit of a spread now on the FTSE and the DAX forming. So I don't believe it's ready to play out, but it is forming at the moment. Whereas on the S&P and the Dow, the spread is actually tighter. So you can see in this little pocket here, it's sort of widening a little bit, but not that much. So we're not really interested in these two plays at the moment for a big reversal. So look, some of the strategies, there are a number of strategies that can be used for pairs trading. You can use market neutral strategies, and returns are not necessarily correlated with the markets. Typically used to hedge market or systematic risk. Long-term timeframes would be used for something like this, and also the other type of strategy is algorithmic, and that's to look to profit from mispricing of instruments. And I think if you are interested in pairs trading. So what I'm saying is that if you maybe put 2 charts side by side, if you don't have an already programmed pairs strategy, you can put 2 charts next to each other. Say, for example, the FTSE and the DAX, and what you'll see is that the DAX tends to explode in one direction, right, a lot quicker than something like the FTSE. I mean, you can compare it against the Euro stocks or some of the other European markets, but you'll see the DAX, it just tends to fly forward. It did it today, and it's, the volatility is quite there at the moment, but it actually does, it moves away, especially on the 1 minute time frame, and the price discrepancy tends to come into play quite a fair bit during the day, especially on around the open time, and it's commonly used for spread-based discrepancies. So again, that's what I was just talking about. So for example, the DAX might move by about 50 points, whereas the FTSE might only move by 10 or 15 points. But that's on a quick 1 minute time frame. With this scenario, using algos to monitor and automatically execute buy or sell orders when a certain spread variation exists, and that's really hard to do on a smaller time frame, especially when the variations will come, and then then they'll start to close up fairly quickly. So if you're not in front of the computer, it's going to take a bit of time. you would need to be in front of the computer to actually execute these. But with an algorithmic system, it will do it automatically. And both, but the key thing here is that you need to remember that both systems will look for prices or a spread to revert back to historical levels. Okay, and when I say historical levels, I mean on a 1 minute time frame, it could be 15 minutes ago, whereas on a daily it could be 3 months ago. All right, so let's have a look here. All right, so some of the calculations. Before trading pairs, you need to address what spread you're trading. Okay, that's very important. And when I say what spread, we're talking about. You need to look at it from either a points movement, which is calculating the difference in the actual movement and spread between the points, usually done over short periods. And the other one is percentage movements, okay, and could be used to calculate the spread difference based on a percentage movement over time, usually over longer periods. Now, we use both methods, and I'd probably say we do lean a little bit towards the points movement because we do trade shorter time frames as well. But we also do trade our co-arb strategy over a longer time frame. So I'd probably say we do lean towards the points movement rather than the percentage. But you can do either. Okay, so let's have a look at some of. I wanted to bring up this because last webinar I mentioned the ASX and the Dow. The spread variation was quite far. So let's take a look at last webinar's example, right? And how it evolved. So what happened was, it was about a month ago. And the ASX was trading at around 52.63. I don't know if anybody that has attended this webinar attended the previous ones. So what happened was 52.63 was the price of the ASX. And the Dow was trading at around 17.056. The difference of the move from where we calculated it, the ASX was down 4.3%, whereas the Dow was actually up 4.19%. And the spread difference here was 8.22%, which was quite wide. And we like it when it's that wide because it gives us plenty of opportunities to get into the trade. Now, I remember someone on the previous webinar mentioned that, but in the questions panel said that something like, but they're two different countries, they're two different scenarios, so you can't really look at it that way. Well, technically you can because the markets tend to move on the upside. That's generally how they're built. So let's say, for example, we took a long trade on the ASX, which is what we did, and we took a short trade on the Dow, right? And this was just a 5% close. We were saying that if it needed to close 5% up, and it would need to move by 9%, whereas the Dow would only move by 0.81%. Now that's unrealistic on the Dow, but at least the discrepancy was there, okay? And these are the prices that they would need to reach. Now, funny enough, literally a few weeks after this webinar, the markets tanked. It wasn't a few weeks; it was actually, I think it was a few weeks actually. So what happened was, this was the chart that we took took an image of, right? So this is the Dow. It was way up here, and the ASX was down here. And the spread was, on this particular case, it was around 6.14 when we took the snapshot. But it ended up being, I think this was one day before. So the next day it ended up being about 8%. So what we were looking for was quite simple, right? I mean, these are calculations that we've done ourselves to enable this. But what we were looking for is effectively, some type of touch. As you can see here, there's a touch here, and then a back a touch here. We're probably looking for a touch somewhere around here, right? If not, maybe further up here. And it might have taken a little bit longer than necessary. But what actually happened was this, okay? This was taken yesterday. What's today? Today's 17th. Yes, it was taken yesterday. And we saw a touch here. Okay, there wasn't actually a touch the day before, but there was a touch yesterday. And that's why I took the screenshot, because the spread narrowed down to about 2%. And effectively, that's the Dow, the pink one, by the way. and that's the ASX. Okay, so the ASX extended itself on the way down originally, but now the Dow's caught up. Now this played out quite well in this particular scenario, and effectively, these are the calculations. Now I'm not saying that we took exactly this trade, but I'm saying these are the calculations. So yesterday, so let's have a look at right here. It was okay. So the ASX was down by 4.03%, and then you had the Dow was down by 4.19. There's the spread long the ASX, short the Dow. The ADR for 2014. Now the ASX is 56, the Dow is 128, and the ratio of that ADR, which is basically dividing that by that, is 2.218. It tells us how many contracts we would trade against the other side. Okay, so we would trade 2.218 ASX contracts compared to one Dow contract. Okay, and on the 16th, the ASX was 52.16 and the Dow was 159.40. Now, it was quite a bit of a wow moment for us because it moved so quickly in our favour. And if you look at here, the move was actually 47 points from there to there, right? And from 170.56 to 159 was actually 1,116 points, which is a massive move in a short space of time. And when you're pairs trading, it's a really cool scenario because even if you had the total, which is the move times the ADR ratio, so it was 47 times 2.8, which is 107. You'd lose 107 points or $107 if you did $1 per point, for example. And if you did the Dow, you would have made 1,116 odd points. Now that's a difference of about 1,000 points. Now look, we haven't made 1,000 points on this trade, right? But we have quite a few pairs trade on at the same time. So we were taking legs off as they were getting closer. Okay, that's just the way our system works. We take one leg off, let the other one play out, or close out both legs. So this is what happened in the scenario with last webinar, and I thought I'd present that. And what I want to do is have a look at some of the other ones shortly. So that gives you an idea of how the simplified calculation of pairs trading can work. All right, let's have a look. Now, system development. With pairs trading, you need to group your pairs and create a matrix with formulas. Okay, you can do that in an Excel spreadsheet. And especially with MT4, you can pull the data through the DDE link and create a live matrix, which is fairly easy to do. If you need a hand, we're happy to help. You need to determine the average daily range for each particular instrument that you're looking at. Look at spread variations. So see which one's moved more than the other. That's pretty much what you'd be looking for. You choose a time frame that suits. Now, look, if you've got a manual system, then 1 minute time frames is probably not going to work that easily for you. But if you've got a slightly longer time frame, then looking at the daily charts and the daily closes wouldn't be bad. That can let the trade actually play out for quite a few weeks or even for a few months. You need to allocate appropriate funds per product. So that's the ratios. So if you're comparing the ASX to the Dow, like I did in the last webinar, the spread ratio would be about 2.218. So you need to make sure that you don't trade one ASX and one Dow. Okay. Open trades when a certain measure of mispricing is reached, or the spread or the points, and close out if the spread range continues to diverge. Now that's a hard stop. So what we've got to be careful of pairs trading is that sometimes we do get a continuation of that divergence or the move apart between the two pairs, right? So in the previous example, the Dow could have kept on going up and the ASX could have kept on going down, right? And that's where we need to place a hard stop and work out from our own risk management perspectives where that hard stop really is. Okay, and if the spread has exceeded its range and it is coming back, then you can look to close out the trade. And what that means is that sometimes particular products will move quite heavily, like the DAX. the DAX tends to extend itself quite a fair bit, especially in volatile times. So you'll find that sometimes the DAX will extend itself quite heavily and then it will revert back. Okay, I haven't... okay. Advantages of systematic trading is you eliminate the human error. It's efficient and accurate, and the speed of execution. So as soon as the spread variance occurs, if you used something like an algo, it would actually place the trade automatically pretty much when it occurs. And it's productive. It works 24 hours a day. The disadvantages of systematic trading, I'd say, is PC outages. And your PC does need to be on all the time. Incorrect trade execution and broker-side latency. When you're placing, especially with something like an arbitrage or a stat arb type system, where you need both trades placed at pretty much the same time in a fast-moving market, then latency on the broker side can actually hurt. It could be a good 3 or 4 points, maybe even 5. It depends on the instrument. The advantages of pairs trading: it can be a short, medium, or long-term strategy. Okay, it eliminates market influence, or it can eliminate market influence, or getting stopped out with extreme market volatility. Potentially, your losses will be lower. Now, that's a potentially the disadvantages are that the pairs diverge even further, leaving you with a loss or even bigger loss than you would have originally had if you just traded the one instrument. There is always a possibility that it does not work, okay? And you'll have a loss on both sides of the trade. So it's not a foolproof system. It needs attention, okay? You need to monitor. I'm a big fan of monitoring. We run about 11 systems at the moment, and I'm a big fan of monitoring. Sometimes we get it right, sometimes we get it wrong, and there's always ways to adjust them. And the smaller profits on pairs trading. So, I mean, effectively they are smaller profits because the Dow example that I showed you was a bit of an extreme, actually. We didn't expect it to do that much, let's put it that way. One of the things about pairs trading is that there is a bit of an overreaction, and noisy markets tend to drive prices apart. Typically this is temporary, and because prices should correct, and usually gaps will be closed. So a lot of times when you see the markets overextend, or there's other strategies called gap fill, but those moves tend to revert back. No trader should depend on only one trading strategy. We don't believe in it. We believe that multiple strategies and multiple instruments is the only way to go. And you constantly evolve your systems. Select products with similar response patterns, and you can make pairs trading as simple or as complex as you like. Okay, sorry, we're going to have questions in a few minutes. I actually wanted to show you some live examples and talk about those. Give me 1 second. Let's bring up these. Okay, so what we've got here is we've got, as we said before, the DAX and the FTSE. There's not much happening with the DAX and the FTSE at the moment. So these are live prices, by the way. They should be. It's on a demo account. See, there you go. The DAX has moved. And where are we? So the DAX and the FTSE, there's not much happening at the moment with the DAX and the FTSE on a daily basis. So ideally, we would have wanted to sort of start progressing in the DAX around these times. And the FTSE is the pink. And then as you can see here, the DAX moved away. The FTSE didn't fall as much. And then, they started to pair up and touch somewhere up here back in September of 2014. The one that's the ASX and so there's the ASX and the Dow, like we were talking about before. So it really, really sort of came into play. Okay, it was a nice move down. It paired up, and it's done it a few times. You'll see back here as well. There's a pair up here. The Dow and the S&P. Not much happening there as well. There's a little bit of a spike there in discrepancy on the S&P at the moment. I'd probably say it's not enough to warrant a trade just yet. But there was one forming. So it was the DAX and the FTSE, and this is the Russell and okay. So this is the Russell and the Nasdaq. If anyone has been watching the Russell and the Nasdaq, the Russell, this moved down. Just the previous one that just occurred over the past week or so. The Russell actually didn't come off as much as the Nasdaq started to get hit, because I think the Russell was getting, in a polite way, smacked down prior to that. Okay, so the Russell started getting smacked down prior to that, but now you can see the Russell sort of, just by this calculation here and our calculations, there's a bit of a spread starting to form, and it's starting to get out there. So what we would probably say is that we would like to see, some more movement on the Russell, probably about further up to here somewhere, about the 1126 mark. And then as long as the Nasdaq sort of stays at around these areas, we would probably look to start taking a trade in that. So there was a bit of divergence around here, that was over the past few weeks. So that was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's over about a month or so, yeah. So we got September here, September, October. So they're the type of things that we look at in pairs trading. There's the Dow. There's the Dow. That's a daily chart. Is that the Dow? Why is that 6,200? Oh, it's 1,627. Okay, so maybe it's my screen. I'll just check one of my others. Yeah, it is. Okay, it must be my screen. Let me just check that. Yeah, okay, sorry, that's my screen. Maybe it's the ratios. So what happened was we got that big move down through here, and whereas the ASX had already made that move. So let me see if I can show you that on a different scale. Okay, if you have a look at that, I mean, this is if you just had normal chart next to each other. What you've got is you've got initial move by the ASX, which started quite a fair bit. Started back in September, whereas the Dow move was late September. So this was early September, the move, as you can see, the 5th or thereabouts, and this one over here was around the 23rd. I'd probably say 22nd, 23rd. So what you've got is you've got a bit of a lag, and that's effectively what we look for. Look, I think with pairs trading, and last time we did the webinar, we had a bit of technical issues. So I just wanted to throw it to some of the audience. Do you have any questions that you want me to sort of look at? Any particular pairs that you have in mind? Because I want to sort of do more of a live scenario rather than a what-if scenario. So if anybody can type in a question, let me have a look. Is there a bottom now in stocks? Look, I don't want to call a bottom. Not because I don't want to. Look, it's Look, what for the time being, as in like for the next few days or for today, maybe, but it won't take much for it to break down further. I think Janet Yellen is talking tonight. So if Janet says something silly, it won't take much for the S&P to reverse a full 80 points. So I'm not going to call the bottom. No, look, look, that's not us. We don't call the tops and the bottoms. I mean, we do look for momentum shifts. I think probably the firm, as a prop firm in general, looks at a momentum shift in the markets. So there's definitely been a momentum shift, but we don't really call tops and bottoms in markets. We calculate levels. Is it going to be the top? Is it going to be the bottom? We don't know. We just look for the shift in price action. Any other questions in relation to getting some of these live pairs going? Yes, we do. We do run algorithms or trading bots. That was one of the questions. Let's have a look. Let me bring up. What I'll do is I'll try and locate some current pairs. Anyone looking at a particular product at the moment that they're trading? Excuse me. I'm trying to read a couple of these. Just one second. Okay, let's have a look at some of the FX pairs, what they've done over the past. Okay, I think a really good one would be. Here we go. Let's have a look. Give me 1 second. Just takes a bit of time to run the charts. Give me 2 minutes. I won't be long. Okay. Euro pullback level in your view. Okay, yeah, I was actually going to bring up the Euro and the GBP. I'm just going to bring that up now. Give me 1 second. What's the code? Just a bit of a process, sorry. We should have, and we have something. All right, let's have a look here. 1 second. All right, daily. That's the. Okay, so what you had here is you have basically some spread variations occurring between the GBP and the Euro over the past few months, especially with all the stuff that's been going on in the markets. And you can see here there's a bit of a spike up by the GBP. The Euro was fairly flat, and then you had the big moves down on both pairs, but there were still price discrepancies throughout that moment. So you had, if you were trading in your shorter time frames, you could have seen some price discrepancies in here. And of course, when the GBP rallied after the this would have been that scenario with the referendum. So there was a bit of a spike up by the GBP, whereas the Euro didn't do much. So there was a bit of a spread trade there happening. And now there's a bit of a spread trade forming. It's slight, but the Euro's sort of moving higher, and you've got the GBP not moving as much. And you can see that on your normal charts. But what you'll find is that, see, these are the levels we like to see. These are our primary strategy called FICM. And we calculate the support and resistance levels mathematically on each of the products that we look at. So ideally, I'd like to see something. I mean, look, I don't know if the euro is going to get up to, your 130 odd level or 129 level. It might. I mean, it's 128.21, so it's only 100 points away. So if it gets up to this level and the GBP doesn't really do much, then I'd really like to see that price discrepancy, come back in. So that would be a scenario where we'd look at where the markets are and also where the ARB systems are. So we would, if we see it coming up to here, we'd probably short the euro, and if the GBP was still down here, we might go long the GBP. But that, that's on the basis that hopefully we get Mario Draghi come out and do some QE or something. Then the euro will probably tank. So they're the type of things that we look at, especially around these green and red levels. Again, they're our mathematical calculations. So that's the euro and the GBP that can be looked at right now. There's something forming there in relation to price discrepancy. Is it ready to go? I'd probably say on a shorter time frame. Look, it's a tough one. It's a tough one because there's not what I'd ideally like to see is probably something of that nature. So that's why I was saying if I saw that euro up around here and the GBP doesn't really do much and that spread, widens to, maybe 6 or 7, maybe 8%, we would probably look at taking those trades or letting the system take them. All right. Any other pairs? So that was the euro pullback level in your view. Euro pullback. We're talking about pairs, but let's have a look at the euro. Give me a sec. I just need to bring it on another screen. Euro pullback. Give me 1 second. So we're going to have a look at the daily. That's not working. Why is that not? 1 second. There we go. All right. So with something like the euro, and especially with the spread trade, again we've got that level in here, which is 129.80. Okay, 1 second. I've got a question here. But you view both pairs in one chart and then try to make decisions. In relation to pairs trading, in relation to specifically pairs trading, the question was for all the other participants, you view both pairs in one chart and then try to make a decision. Yeah, what happens is that the reason why we look at them in one chart and the way we've created these is specifically we want to see how far they are moving apart. Okay, that's the key, right? If we can see how far away they're moving apart, then, I mean, the calculations are still there in the background, so you've got calculations in here as well, but that will give us a really good idea. And then as soon as, especially when, that allows the system to do what it needs to do, right? In relation to just normally looking at the euro dollar from a different perspective, then we would look at it as a normal chart. But from a pairs point of view, we would like to see the discrepancy pan out further, and the calculations are over here anyway. So the system works off these calculations, but this is more of a visual thing for us and for myself and my traders to look at, so that if there's something there that they see that they believe that can take the trade, I mean, we might take the trade manually prior to the system doing it. So that's why we look at both pairs in the one chart. I mean, look, there's been some really good questions and comments here. I think what I wanted to say was, look, before I mean, these aren't. I want people to sort of get to understand that pairs trading is a good quality product to look at. As I said, a lot of traders know about pairs trading, but I don't see them doing it. Very, very little traders that come to me actually pairs trade. Now, again, you can make it as complex as you like. You can bring up all these mathematical formulas and create different spreads and a whole bunch of different things. But I think if you start simply and look at the way we looked at, the system picked up the spread variation between the ASX and the Dow. Now, we didn't make those figures up. That's how they were. So I think it's important that people understand that. And look, we've got a few more minutes to go, but I just want to, I'll go back to the slides in a second, I'll go back to the charts in a second. But I think if anyone really is interested, and I'm offering a genuine mentoring session via Skype, right, to anyone who's genuinely interested, right, in talking about pairs trading. Now, I mean that's my direct line here it's our direct line, but in Melbourne it's 6. Oh, what happened there? And that's my direct email. Now, you can download our trading guide. Our trading guide gives you a little bit more of an idea of how we look at the markets, right, as a trading firm. But at the same time, only if you're genuine, please, seriously, ping us via Skype or message us via Skype or send me an email, and we'll tee up a time and I'll do a 30-minute mentoring session about what you want to do. Now, there's no obligation for anything after that. I think it's important that if people are keen to learn about the markets, I'm happy to spend time with them. And something like, as I said, like pairs trading, I really think that if you have a particular strategy that you've got at the moment, look, have a look at pairs trading, introduce it into your arsenal of systems. Now, you don't have to do it on a 1-minute time frame. You could do it on a daily basis, and that's not hard to manage. So I think if you build that spreadsheet, or if you need a hand with something like a spreadsheet, happy to sort of do that over the call and show you how to sort of get started. Look, I mean that's basically all I've got. I really don't have much more. It's pretty easy to sort of get started on pairs trading. Is there any other questions that you'd like me to answer before the webinar finishes? Because it's a very short webinar. It's only 45 minutes, and I think we've got a couple of minutes to go. Any questions? The indicator down. What does that? Could you just, Mr. C, could you please elaborate on that? I don't know what that means. The yellow line, yeah. That's the spread. The yellow, okay, sorry. Okay, so the yellow line for us is the spread, okay? So you can see here it's sitting at around 0, okay, which is that one there, 0.16, right? The purple line is actually, I should have changed that to white for you guys. The purple or the magenta, that's the Dow, and the blue line is actually the ASX or the white. That should have been white, sorry. So effectively it just gives us the spread between the two lines to help the system pick up the numbers. And it's a visual thing as well, so especially when traders are monitoring. Okay, I hope that answered your question. Any other questions? I'll bring up that slide again if anybody wants to take down my email and take up the offer of a 30-minute mentoring session. So It's free, by the way, just to help you guys sort of get started into, if you haven't been trading pairs trading, then we'd help you get started. All right. Well, look, thank you all for coming along. Really do appreciate it. And I think that's it for us at the moment. And hopefully I see you all in our next webinar. Thank you again.